Hey everyone, and welcome back to another video for today. So in today's video, let's talk about 10 companies with pricing power. Yes, these might sound like extremely boring companies, but companies that do have pricing power are extremely powerful. And usually the trend that you will see with their business and the stock is up and to the right. Now, what is pricing power? Pricing power means that a business can increase prices without losing more than a marginal percentage of its customers, if any. Generally, having pricing power also means a business can charge higher prices than competitors for similar products. Think of a Netflix, think of Amazon Prime, maybe Spotify as well. All of these companies are, of course, raising prices, have been raising prices before. I think most of us are still using these services despite having competitors. I think Amazon Prime is still the best subscription out there for everything that you're getting, especially in the United States. In Europe, it's extremely cheap. It's extremely cheap, but that's of course because our experience with Amazon Prime is definitely not the same as what you're getting in the United States. But let's talk about some other businesses that do have pricing power. And again, boring businesses, I know, but I'm pretty sure that a lot of you own some of these companies and maybe even use their products and services. So let's dive into that. I also want to thank Fiscal.ai for supporting this video. If you don't know what Fiscal.ai is, it was previously FinChat, stock research platform that you've seen on this channel time and time again. There's a link down in the description and in the pinned comment that will get you 15% off. New users can also try it out 2 weeks for free, Fiscal Pro for free. So why not? And I also, of course, want to thank everyone that has been using my links over the last couple of weeks and months. I really appreciate that. And hopefully your investing journey is much better right now. So company number one is American Express. Yes, American Express, tremendous company. Performance-wise of the stock over the past 5 years is up 225%. This is a company worth $230.5 billion. Trailing PE 23 times, forward PE 20.4 times, gross profit margin of 64.2%, net 16%, and free cash flow margin here of 17.5%. This is a company, of course, that is not growing extremely quickly, but it is still growing, top and bottom lines, and they do pay a small dividend. Now, if we look at American Express, average fee per card over the past couple of years, this has grown at a compound annual growth rate of 12.6% since the December quarter of 2019. We were at 61, we're now at 117, with the recent increase being quite sharp. Looking at gross profit margin and free cash flow margin, there is here something to look at. Because 10 years ago, gross profit margin was at 73.9%, we're now at 64.2%. Free cash flow margin is quite volatile. As you can see, we go up and down, up and down, up and down. But more recently, we have been going down for the last couple of years. We're at 37.9% in 2022, then 30.6% in 23, 20% in 24, and now 17.5% in 2025. Now you might say that's extremely bad. Well, not really, because American Express is also a lender, and more recently they have grown their loan balances quite a lot, and that, of course, all in all does impact free cash flow. Moving on to the next company, and that's Moody's. Moody's has a market cap of $91.4 billion over the past 5 years. Stock is up 73.4%. Has a 43.4 times trailing PE and 34.6 times forward PE. Margin-wise, here we're also looking at a very strong company. 72.8% gross profit margin, EBITDA 46.3%, operating 42.6%, 29.2% net, and 32.4% free cash flow margin. Here as well, this is not a fast-growing company, but this is a solid compounder. If we look at Moody's ratings, revenue, and operating income, what can we see? Well, it goes up and to the right for the last 13 years here. We have that data. Moody's investor service revenue has grown 5.9% compounded for the last 13 years, and operating income has grown to compound annual growth rate of 7.6% for the last 3 years. And of course, we did have a negative impact right here back in 2022, 2023. As for margins, gross profit margin has stayed at around 72% for the past 10 years. Free cash flow margin, same thing here, although we did have some volatility, of course, after the pandemic or during the pandemic, but all in all, it has stayed here as well, around 32% or so for the past 10 years, sometimes a bit higher, sometimes a little bit lower. Moving on to a company that has been in the news more recently, and that's of course Fico or Fair Isaac Corporation. Fico is a company worth $36.5 billion over the past 5 years. The stock is up 261%, but more recently it has experienced a drawdown at one point of around 43-44% or so, now down 36% from the recent highs. This is of course a expensive company, but as you will see, margin-wise, probably one of the better ones out there. So trading PE 58.9 times, forward PE 44.9 times. As for margins, gross profit margins 81.7%, EBITDA 46.6%, operating 45.9%, net 32.8%, and free cash flow margins of 40.2%. This is a company right now that is growing a bit faster than the previous companies that we've covered here. Revenue forward 2 years compounded close to 15%, and EPS 22.5%. Looking at FICO's scores revenue and operating income over the past 12 years, we can see here that total scores revenue did increase by 16.7% compounded and operating income by 18.7%, also same period. And so when you look at those two numbers right here, for scores revenue and operating income, that's an 88% margin. Contrary to the other companies that we've seen here, if we look at gross profit margin and free cash flow margin, that has actually improved over the last 10 years. Gross profit margin was 67.7% 10 years ago. We're now at 81.7%. Free cash flow margins was 14.5% 10 years ago. We're now at 40.2%. If you do want to learn more about FICO, my friend Emir did an excellent video and also wrote quite a lot about it in his Substack. Up next, we've got Ferrari with one of the better tickers here, Race. Although if you follow F1, racing might not be in their books anymore. So yeah, that was a shame. Anyways, Ferrari, $84.7 billion in market cap over the past 5 years. Stock is up 143.2%. Stock has a trading PE of 45.8 times and a forward one of 43 times. This is a company that, yes, is still growing, top and bottom lines. I mean, revenue 8.2%, EPS 9.5%. Not a high growth company, but for a car company, look at those margins. Gross margins 51.2%, EBITDA 33.4%, operating 29.1%, net margins 22.9%, and free cash flow margins of 26.6%. I mean, makes sense when you're selling quite expensive cars. And I mean, if you look at the estimated average price per vehicle over the last 13 years, well, that has grown by 87.2% or grown at a compound annual growth rate of 5.1%. Yes, this is pricing power. This is pricing power because they know, right? They know they make Ferraris. There are 10 people that want a Ferrari, they'll make 9. It's quite simple. Margin-wise, over the last 10 years, has improved, although as you can clearly see here, gross profit margin has fluctuated in those, well, high 40s, low 50s area. As for free cash flow margin, more recently, we have seen a small improvement. We were at around 21% or so for the last, well, let's call it last 10 years on average, but more recently we have seen a little increase here to 26.6%. Up next, we have ASML, semiconductor company, semiconductor equipment maker, that is, $287 billion. In market cap, you can buy it in the US, you can buy it in Europe as well on the Amsterdam Exchange. Over the past 5 years, basically doubled, let's call it a doubling here, trailing PE 27.2 times, forward PE 28.3 times. Margin-wise, very good. Gross profit margin 52.5%, EBITDA 37.6%, operating 34.8%, net 29.3%, and free cash flow margin of 28.7%. This was, of course, one of those examples, one of those companies that did previously grow much, much faster than what it's expected to grow over the next coming years, right? Of course, ASML is part of those companies that, yes, in an investing cycle, especially in the, of course, semiconductor industry, this is one of those companies that will gain from that quite a lot. Now, looking at the average price per EUV machine over the last 13 years, that has increased by 13% compounded, so by 332%. It's quite something, right? And I do believe that there were reports that came out that said that their next EUV machine is going to be even more expensive than the one that they've released, I think, a year or two ago. The thing here is that the companies, the TSMs, the Samsung, the Intels, of course, it would probably be a domino effect. Like if one orders a machine, the other two will have to order them as well. But right now, it seems like the sentiment is, look, the machines that we're buying right now, the machines that already cost us so much, can do quite a lot. And so we're not really seeing the pressure on us to buy the upcoming one. That said, ASML still has a monopoly, so I think they'll do fine in the future. Gross profit margin did increase over the last 10 years, went from 45.1% to 52.5%. Looking at free cash flow margin, here you can see it's a bit all over the place. It's a bit all over the place, but we are now at 28.7%. We're previously at 32.3%. Sometimes you're a bit lower, sometimes you are much higher. It really depends on what type of year we're in or what stage we're in the investing cycle. We've talked about American Express, so let's talk about Visa. Visa is a company worth $677 billion. Visa over the past 5 years is up 65.9%, so I do believe that it is underperforming the market. Valuation-wise, 34.2 times, trading PE, 28.2 times forward PE. This is a company, of course, with insane margins. Gross margin 97.8%, EBITDA 70, operating 67%, net 52.2%, and free cash flow margin of 56.8%. This is still a company that has been growing low double digits, still expected to grow low double digits for the next coming fiscal years. Looking at Visa's take rate over the last couple of years, that has also grown nicely, right? Might not look like a lot, but I mean, the amount of payments that they're processing, every point here counts. And so the take rate went from 0.18% to now 0.24%. That's a compound annual growth rate of 6.3%. So if we look at margins right now for Visa, gross profit margin, of course, insane, right? Above 97%. Free cash flow margin has also improved from 44.5% to 56.8%. Moving back into the semiconductor space, we have here TSMC. TSMC is a company worth $984 billion, so probably another $1 trillion company pretty soon. Over the past 5 years, stock is up 191%. It has a trading PE of 20.8 times and a forward one of 3.9 times, which I do think this is going to be an error here. Margin-wise, gross profit margin 58.6%, EBITDA 69.1%, operating margin 48.8%, net 42.5%, and free cash flow margin of 27.6%. Of course, TSMC, well, there is no NVIDIA, AMD, Apple, etc., without a TSMC. But then again, you could say that there's no TSMC without an ASML. If we're looking here at revenue per wafer shipment, that has grown at a compound annual growth rate of 15.6% since the December quarter of 2019, right? It was quite slow, and then it started to accelerate. And yes, currently it did go down for 2 consecutive quarters, but there are also some reports that because of the tariffs that TSM is going to raise prices yet again. But I mean, this is of course also pricing power. Looking at gross profit margin, that has increased over the last 10 years, of course, from 48.7% to now 58.6%. Free cash flow margin, of course, fluctuates on the amount of investments, but still quite good. We're at 32.3% 10 years ago. We're now at 27.6%, but of course, the company is just a lot bigger today. Moving on to the last 3 companies, one of them is the Coca Cola company. The Coca Cola company is worth close to $300 billion. Over the past 5 years has only grown 39.3%. Of course, you buy it because of the steady dividend and the increasing dividend as well, plus maybe the predictability of future free cash flows. This is a company that has a trailing PE of 24.2 times, forward PE 22 times, margin-wise 61.4% gross profit margin, 33.6% EBITDA, 31.2% operating, 25.9% net, and then negative 1.5% free cash flow margin, but I do have a comment for that. Looking at Coca Cola, revenue growth from price mix has also increased especially over the last couple of years. On average, it was 4.15, which means this is not just them selling more, it's probably them also selling the same thing, just better prices. Well, better prices for them. Looking at margins, gross profit margin has stayed about the same for the last 10 years. Free cash flow margin has been dropping, more recently increasing capex, but more recently we also have seen a significant impact by a $6.1 billion contingent consideration payment, which is why you're seeing this. Moving on to a company I did not know about before, and that's this one right here. I can try to pronounce it, but I don't think I'll be successful. Grupo Aeroportuario del Pacifico. I think that deserves a thumbs up. This is a company worth $12.15 billion. Over the last 5 years, it's up 211%. Trailing PE 25 times. Forward PE, I think here again there is a sort of error here. Margin-wise, very good. Gross profit margin 81.7%, EBITDA 61.6%, operating 50.8%, net 28%, and free cash flow margin of 30.3%. Still expected to grow quite nicely, top and bottom line, over the next coming fiscal years. Now, what do? Well, together with its subsidiaries, they manage, operate, and develop airports primarily in Mexico's Pacific regions. And so here, if we look at the aeronautical services revenue over the last 13 years, that has grown at a compound annual growth rate of 15.9%. And of course, there was here that dip because of COVID. Looking at margins, gross profit margin has stayed about the same, did improve a little bit over the last 10 years. Free cash flow margins were quite high 10 years ago, then started to stabilize high 30% or so. More recently, we have seen quite a lot of fluctuations, but we're still at 30.3%. And now lastly, Verisign. Verisign is a company that underperformed the market over the last 5 years by quite a lot. It's only up 27.3%. It's a company worth $25.5 billion, trailing PE of 32.5 times, forward 30 times. Margin-wise, very, very good, right? I mean, free cash flow margin is close to 60%, gross profit margin close to 88%. Yes, it's not a fast-growing company at all, but if we look at the average cost per domain registration over the last 5 years, went from 7.7 to now 9.4. Incredible increase here, and it doesn't seem like that has hurt the business at all. You look at gross profit margin over the last 10 years, went from 81.8% to now close to 88%. Free cash flow margin stayed around the same for the last 10 years, 59.4%. We're now also at 59.4%. And so that's about it for me in this video. Do you have any other companies that have an insane pricing power? Could we say that Nvidia, Apple, does that fit into the category? I could probably argue yes. Let me know if you have other names down in the comment section below. Hit all the buttons, would really appreciate that. Check out fiscal.ai, link is down in the description and in the pinned comment, and we'll see each other in the next one. Bye bye.